Okay, in this session, course session 7, we're going to look at how money moves through the business, and we're going to see how that visually corresponds with what the accounts are saying. So this brings together everything we've done in terms of cash flows and financial modeling and accounts and how balance sheets and profit and loss accounts and cash flow works and so on. So let's move through. So it's useful to visualize the way money moves through the business and match that to the main accounts. So we're going to look at how we build a balance sheet, the working capital cycle, the trading cycle, the whole cash cycle. And then we're going to think about a final point, which is a simple but very important observation about the balance sheet, which tells us how all costs, of course, in the end, must pass through the profit and loss account. All the assets in the balance sheet we know end up going through the profit and loss account as a cost. So first of all, let's look at it from the point of view of the balance sheet. So we know that on the liability side of a balance sheet, a business tends to get its finance from two principal sources, from the bank in the form of debt, and from shareholders in the form of shareholders' funds or equity. Principal two liabilities on the liability side. And of course, those two are sources of cash. And at the beginning, we can imagine a business that borrows some money, raises some money from shareholders, and it just has some money in the bank. Now, it can do some things with that money. It can convert the asset of cash into other types of assets. Long-term or fixed assets, buildings, machinery and equipment, and short-term assets, assets that we would typically realize or sell within a year, raw materials, work in progress, finished goods. So those fixed or long-term assets usually have a lifetime of a year, often well beyond, and these current assets, which are raw materials, work in progress, finished goods, and of course cash, have a life which is some amount of time less than a year. Now there's two other things to observe here. We can look at short-term liabilities, which is money we have to repay probably within the year, and that's normally someone who's provided us with something and we haven't paid yet. It might be a supplier who gives us 3 months to pay. Similarly, on the asset side, we may have a customer we've given some product to, but it hasn't paid us yet. So those two items in blue are just delayed receipts or delayed payments. Let's look at the working capital cycle. So again, we can see on the right-hand side here, on the liability side, the money coming from the bank, money coming from shareholders, and strictly speaking, money which we haven't had to pay yet. So that's a source of cash. The classic working capital cycle is we use our cash, we pay suppliers for raw materials, which we turn into work in progress and ultimately finished goods. Then we sell it to customers and customers pay us cash. And here come those two delayed elements again. One is trade debtors. Customers may buy something from us, but they're not paying us yet. We might give them a month to pay or 3 months to pay, but we get it eventually. It comes in as cash. So that trade debtor, the person who owes us money, is an asset, and when they pay us, they move from being a trade debtor asset to a cash asset. Similarly, trade creditors are people who have supplied us, but we haven't paid yet. So that's a liability we have, and eventually we pay them. So that red cycle there, that represents the working capital cycle. Cash to suppliers who provide us with raw materials, which we turn into finished goods, and the customers pay us either immediately or on a delayed basis. Okay, let's look at the trading cycle, which just builds on the working capital cycle a little. Of course, when we're trading, there's other places our cash goes. The costs of goods sold, of course, is not just raw materials, but it's paying the workers who are directly involved in building or delivering the products and service that we have. And we have overheads, everything from management to marketing, research and development, sales, distribution, rent, rates, electricity, and so on and so forth, plus depreciation and so on. Now, we hope that with the working capital cycle, more cash comes in than goes out, and we can cover the cost of time and materials on building our product and overheads so that we've got money left over, and we may be paying interest as well. And that money left over is profit, and profit goes to the shareholders. It builds up in the equity quantity. So every year when we make a profit, all things being equal, that value of equity or shareholders' funds will go up an amount equivalent to net profits, profits actually after tax. We can see that interest as a cash movement can go to service the debt, and we know that there's times when we may pay dividends out to shareholders. So that's all really the characteristics of what happens to cash. There's one other thing, and that is we may be buying fixed assets, property, equipment. We may sell some as well. Capital expenditure refers to the buying of fixed assets. So we may sell some and get money in. We're more likely in a growth phase to be spending money on those things. That doesn't affect our reported profit, but it affects, of course, our total cash balances. So this brings together working capital, the balance sheet, how we fund the business, the relationship between liabilities and assets, which always balance, cash flow and trading. So all the accounts, balance sheet, the cash flow account, and the profit and loss account or income statement are all captured really in these flows of money. The last observation is this. Every asset, I mentioned this earlier, every asset in the balance sheet is effectively a cost that we have not yet released to the profit and loss account. Cost of inventory goes through the profit and loss account. The moment we sell something, we match the inventory cost, the cost of raw materials, against that sale. So out it goes from the balance sheet through the profit and loss account. Fixed assets, buildings and equipment, long-term assets, all eventually go through the profit and loss account, either by depreciation, a little bit each year, or amortization, or through selling the asset. In the end, it all goes through the profit and loss account as a cost. Same for intangible assets, that's intellectual property rights, for example, amortized or eventually sold. So we can see the balance sheet as like a car park full of costs waiting to go through the profit. And so that's how we visualize the cash flows running through the business.